Good afternoon, everyone. Allison Schaberg here, Consolidated Planning Group. We are excited to be back here today with Teresa Ferruzzo. She is a CPA, and she's going to be talking to us today about the income tax issues for special needs trusts and things that you need to be aware of. This is something I would say that questions come up all the time of how special needs trusts are taxed and how to distribute income and certain things that we need to keep in mind when it comes to planning for our loved one with a disability. As you all know, we have a special needs trust in place for our loved ones with a disability because it's a way that we can leave money for their benefit that is also going to preserve eligibility for state and federally funded programs, which is the necessity of the special needs trust. And there's a lot of questions that come up all the time about this, so we're going to take a deeper dive into that. I always like to start with a few housekeeping items. We are in webinar mode today, which means that we can't see you or hear you, but we know you're there, and we're glad that you're here and have joined us today. Our chat box is open, and you can put your questions in the chat box. If you sent a question in ahead of time, I have those, and we're going to be working through those throughout our presentation today. If you are planning your time, we're going for an hour today, so you can plan accordingly for that. All of our past webinars live on the Consolidated Planning Group YouTube channel. Consolidated Planning Group is a holistic special needs financial planning firm. We're nationally certified as Social Security advisors, members of the Special Needs Planning Academy, chartered special needs consultants. And our whole firm is nuanced in helping you plan for the future of your loved one with a disability. We help people understand how and when to apply for specific benefits. We answer questions like, who's going to care for my child when I'm gone? How much money do we need to fund a special needs trust? How do we retire, stay retired, still have enough money to fund the special needs trust? But what about our other kids, weddings, college, things like that? We help with that. And one of the things, if you've attended our webinars in the past, you've probably heard me say before, and I think it's critically important. So whether you work with us, you work with Teresa, or whoever you work with, we suggest that your situation is specialized, and it is important for you to work with a specialist that is specifically nuanced on planning for special needs. I don't do what Teresa does. Teresa doesn't do what I do. And when we've got those estate planning attorneys that help you set up the special needs trust, your wills, your powers of attorney, things like that, guardianship, those attorneys are specifically nuanced in the law. And that's what they do. So when it comes to planning for special needs, you want to have the right people on your team. And sometimes the right people on your team are multiple professionals. So when it comes to planning for special needs, we really help you set up a lifetime care plan and protection plans in place. We do a lot of discussion regarding transition planning, ABLE accounts, future care cost estimates, understanding state and federally funded benefits and programs and how to maintain those eligibility. And one of the things that we'll say is, when it comes to a financial advisor, fewer than 0.1% of financial advisors in the U.S. are nuanced with special needs. So while a lot of financial advisors hold some of the same similar license, they are not typically working with special needs families. And that's when we see things accidentally in the wrong buckets. People losing eligibility for state and federally funded programs. When we see attorneys that are generalists that are not really nuanced in special needs. We see special needs trusts that maybe weren't set up properly and failed the Social Security test to qualify as an acceptable special needs trust in the eyes of the Social Security Administration. And that's why it's so important to get the right professionals on your team. So when it comes to planning for special needs, developing a future care plan is going to answer a lot of questions. And I would argue that it would give you a lot of peace of mind. We hear from families all the time. I myself am a parent to multiple kids, adult kids with disabilities, and I know Teresa is a parent herself. And I would say, in general, what a lot of parents say is that they lose sleep at night, or they worry about these things of who's going to care for my child when I'm gone. what happens when I'm no longer here or no longer able to provide the services that I once did. So when it comes to supporting your child, we have people on here from all across the United States, not just in Texas. We are domiciled in Texas. But I would say that, we have people that are all walks of life, all different types of disabilities, and all ages. So you might be here because you're just learning, you're just dipping your toe in on special needs trust and taxation. You may have a new diagnosis, and you might be here because you're in your 80s and you have a loved one with a disability that's in their 60s, and you're realizing that you might not be able to provide the care that you always have as you continue to age. So wherever you are in your journey, there's something for everybody here today. So one of the things that we talk about is, when we're thinking about transition or post high school, researching what those options are. Does your school have a transition program that they could stay in until age 22 or past age 18? What are we looking at for your loved one with a disability post age 18? Are they going to go to work? Are they going to go to school? Is there a transition program? So we always suggest looking at those options early. We do lots of webinars on these topics. So what we're trying to prevent is your kids coming home at 18 or 22 and there's no plan. They're just home. They don't have community. They're not learning and growing. So we want to see some options for that. We suggest touring facilities that maybe have residential programs, partial residential, respite care programs, maybe looking at some of the adult summer camps that are available. Obviously, for kids, there's always summer camps available for kids, but there are summer camps available for adults with disabilities as well. And that might be what we would call a good transition of dipping their toe in of sleepaway camp, even if they're living with you. Just some kind of sprinkling that in throughout the years. And then we always remind people to name successor caregivers thoughtfully and carefully. Your other child may not be the best caregiver or the best future caregiver for your loved ones. So really looking at the person, do they have the capacity? Do they have the wherewithal? Do they have the willingness for the job? Because I think there's a lot of people that have stress and anxiety about who that person is going to be in the future. And sometimes that changes throughout your life. Who you thought was going to be is not, because they're no longer here or no longer capable due to their own responsibilities. So we want you guys to be thinking about that. So we're going to take a deep dive into special needs trust taxation. And having said that, I'm going to turn everything over to you, Teresa. It's a pleasure to be back with you. Thanks for joining us today.
Yeah, thank you, Allison. Welcome, everyone. Today, we are going to talk about special needs trust taxation, specifically how trusts are taxed, how beneficiaries are taxed, and where families and advisors most often make mistakes. My goal is I hope that everyone will take a few of the slides and information away with some extra knowledge. I hope you leave understanding where things can go wrong, and more importantly, how proactive planning can protect benefits and reduce unnecessary tax. My name is Teresa Ferruzzo. I am a parent of a special needs daughter named Elena. She's about to be 23. She has Coffin-Lowry syndrome. I've been in public accounting doing accounting work as well as taxation work for over 30 years, and naturally have kind of led my practice into, or our practice into, surrounding it with a lot of special needs type of issues. By nature, I'm around it. It's near and dear to my heart. And as Allison said, there's not many people that know much about the taxation side of it. So Allison and I have teamed together along with attorneys, and it is good to have a resource in every avenue, not just one specialist, have multiple specialists and listen to multiple people to make sure you have the facts straight. The outline today, we're going to start with special needs trust, the different types of trust versus the beneficiary taxation, which is on 1041 versus the 1040. We'll talk about inherited IRAs and how the Secure Act allowed you to stretch your lifetime of the inherited IRA. We'll talk about ABLE accounts and the tax treatment and how you can use that for tax planning. And then we'll end with common mistakes and proactive planning. Okay, so why does special needs trust matter? The primary purpose, as most of you probably know, is you want to preserve benefits for your loved ones, specifically SSI and Medicaid. Tax planning is secondary, but it becomes very critical and important over time, especially as the third-party trusts are funded. This is an area where tax law, benefit law, and estate planning all intersect, and mistakes in one area can cause effects in the other areas. There are two primary types of trusts. First being the first party trust, which is also called a self-settled trust. Those trusts are funded by the beneficiary or the individual's own funds. It could be a settlement from a lawsuit for an accident. It could be child support. It could be inheritance from an IRA where the parent didn't know that they shouldn't issue the beneficiary in the special needs dependent's name. It could be, as I said, child support. Third party trust, that is where someone other than the beneficiary funds the trust. It could be grandparents, it could be parents, it could be a second to die policy. And from a tax standpoint, first party and third party trust income are handled very differently on the tax returns. So first party is considered more of a grantor type trust. Third party is considered more of its own trust, meaning the trust itself will file the tax return. This is one of the most misunderstood concepts in special needs planning. What counts as income for SSI and Medicaid is not the same thing that the IRS counts as income. This often gets confused by several clients that I have, and they think that a distribution from a third-party special needs trust to the individual it gets reported on their individual tax return is going to affect benefits, but it will not. So SSI and benefit income is an example of it is more of along the lines of cash. If you have more than $2,000 in your bank account, or if your parents are paying for shelter, that's considered in-kind support. That is what the definition of income is for SSI Medicaid government rules. For IRS taxable income can be a distribution out of your special needs trust. It can be interest income that hit the special needs trust. It could be dividend income. So income is defined completely different for government versus IRS rules. Let's talk now about Form 1041. 1041 is very similar to what you file on your individual tax return, which is called a Form 1040. Every year, if you have a third-party special needs trust that earns more than $600, that could be $600 in interest income, dividend income, proceeds from selling stock, your third-party special needs trust is required to file Form 1041. I think there are several people on here from other states as well. It has a federal tax requirement as well as if you're in a state that requires a state tax return, the state also has to file a Form 1041 for the state. One thing to note is that trust income tax rates rise very quickly, meaning that you get to the highest tax bracket very quickly at the trust level versus at the individual 1040 level. And we will get into more of this later in the discussion. One important type of trust is a third-party trust that can be qualified as a QDS, a QDT, which is a qualified disability trust. There are specific rules on what qualifies for the qualified disability trust, and you can also lose the status of qualified disability trust if you accidentally treat the trust as hold on, I had an example here. What you don't want to do is lose the qualified disability trust status, because if you lose that status, you will lose out on a large exemption. So currently for the trust, you're allowed a $100 exemption on your Form 1041. However, if your third-party trust can be deemed and defined as a qualified disability trust, you can get up to $5,300 for 2026 and $5,100 as an exemption. It's almost like a personal exemption that you used to be able to get on your Form 1040. This is a very important exemption that you want to have when you have your third-party special needs trust funded. There are rules surrounding it specifically, and there are ways that you can accidentally even make this status go away. I can give an
Teresa,
example. Alice, go ahead, Allison.
we had a question. You had mentioned that with a third party special needs trust, if it earns more than $600, then the 1041 needs to be completed. And one of the questions was, is that earned and unearned income, or what is that?
Yes,
So I
it is earned and unearned income. Yes, any income reported.
Okay.
It could be interest and dividends. Correct.
Okay. And then the other question is if the major input to the trust is a IRA or 401k, is the income to the 401k taxed?
Yes, if it's pre-tax money, it will follow the same way as it would be taxed on your individual tax return. So pre-tax money, yes, is taxed when it is just when it's distributed out of the 401k into the third-party trust.
Okay. Thank you for answering that.
Sure. One thing I wanted to mention earlier that was important about the qualified disability trust is that if you commingle, let's just say, here's an example of a way you could get in trouble. If you commingle the beneficiary's own income, let's just say it's personal injury or it's back pay for SSI, and you put the first party trust money into the third party trust, this can automatically terminate the qualified disability trust status, which is something you do not want to do. So you make sure to keep your third party money separate from your first party money when it comes to third party special needs trust. Okay, I wanted to talk a little bit about the tax rates and how significant the trust reaches the 37% tax bracket at approximately $15,650 in income. If you compare that to the individual tax return, you will not reach 37% on your individual tax return until your income gets to $626,000. So you can see just by these two numbers how important it is to do tax planning at the trust level after the trust is funded, because you will want to take distributions out of the trust that will then add taxable income to your individual tax return at the lower tax rate. Okay, so now that kind of leads us into talking about what's called distributable net income and a Schedule K1. So distributable net income basically controls how the trust and the individual is taxed. It determines how much income the trust can deduct and how much is carried out to the beneficiary. Cash distributions and taxable income are not the same thing, and this is where many K1 errors occur. I will give you an example as this gets kind of complicated. So I'll just give you a quick example. So let's say the third-party special needs trust, in fact, did have a 401k, and the special needs trust is the beneficiary. and it has to take an RMD of, let's say, $10,000. So that $10,000, let's make it 15, since we know the 15,000 is where the 37% tax bracket came into play in the previous slide. So $15,000 becomes taxable income into the special needs trust. You file the Form 1041 and you will be paying 37% on that $15,000. Whereas if you properly planned and you use some of the funds out of the trust to pay for things such as summer camp, Allison mentioned, overnight camp, a trip, go to Disney, what happens is that is called distributable net income, which means that $15,000, say the trip costs 10, of the $15,000 that's taxed at the trust level, 10,000 of it, because you spend it out of the trust on behalf of the beneficiary, would then be issued on the K-1, which will go on their individual tax return at the lower income tax rate. So planning is really important once the third party special needs trust is funded, and how that comes into play is the distributable net income. Okay, so this slide talks about how we talked about the K-1 in the slide previously. And so you do have to, it gets a little tricky. You want to do tax planning on the special needs trust side, but then you also have to look at the individual income on the individual's tax return from the beneficiary as well. Because depending on the amount of money that gets distributed to them, they have to pick it up on their individual tax return. It could trigger that Social Security benefits are taxable, or if any of them are on government insurance, it can also lead to them having a penalty and having to pay back the subsidy.
We have a couple of questions I want to go over with you. One person says, what do you do with the money that you have to take out so you lose qualifications to special programs like paying for meds and such?
Okay, so if you're talking about taking funds out of the special needs trust, what you do is you can pay for things out of the special needs trust and pay for them directly. Do not put the distribution into the beneficiary's bank account. You don't want the bank account to rise, their individual bank account. You want to pay for things directly. So maybe get a debit card, or if the parent pays for it and then gets reimbursed. You just don't want to put it in the beneficiary disabled bank account. I hope that answers it.
So one person says, can you distribute an inherited IRA RMDs to an ABLE account? That's really a loaded question because an inherited IRA for an individual with a disability, as long as you proved by October of the following year of death that the individual has a disability, that individual could qualify for a lifetime stretch on the RMDs as opposed to having to take it out over a 10-year period. But what the question is can these RMDs go to an ABLE account? So I mean, I know that like if the RMDs came out, that it could be turned around and moved to an ABLE account, or it could come out and go into a non-qualified special needs trust account. But as far as directly going from the IRA or 401k directly to the ABLE account, I think it depends on the state and it depends on the ABLE account that you have. Do you want to chat about that?
Yeah, so if you have to take a RMD, which is the minimum required distribution for an inherited 401k, you have to take that no matter what. It is considered income to the third party trust. However, you can use the ABLE as a tool, and that's what we advise that you do. You can set up the ABLE and you can then fund the ABLE up to, I believe this year it's up to $19,000. However, when you do fund the ABLE out of the third party special needs trust, that then will become income that's pushed down to the individual at the lower tax rate at the 1040 level. I hope that answers the question.
And then the person says the inherited IRA is already in a special needs trust. And then, but a lot of times what we've seen too, Teresa, and you can tell me what you've seen, is, you've got the required minimum distribution that could qualify for the lifetime stretch, but for more favorable tax benefits on the special needs trust, we want to be distributing income anyway. So if we're distributing the RMD, and that may be doing two things at once of distributing income, like it may be accomplishing the RMD while accomplishing distributing income from the trust. Does that make
Mm-hmm.
sense?
Yeah, it is two things. So you have to keep them separate. So the RMD rules, regardless of what you do with the distribution money, it has to be taken. So if your RMD for this year's $10,000 based on the balance from December of last year, you have to take that. There's no way around that. So that coming into the special needs trust will be taxed at the special needs trust level, which is the higher tax rate, unless you think about it during the year and do tax planning and spend down that money to where it can then be shown as a distribution, which will go on the K-1, which will end up on the individual's tax return. Whether
And
you're
then
funding an ABLE or paying for camp or paying for a Disney trip, whatever it is.
And then there are such things, and I know we're not getting in the weeds with that today on the qualified income trust. So if there's a military pension or other, monthly income that would be coming in that might otherwise disqualify them, there are such things as qualified income trust, and having that set up in such a manner that it doesn't affect their benefits. Do you have any slides that's going to talk about that today? I don't know that we talked about that.
Are you talking about, is it going to be a first party trust? They inherited it and it's their
Right.
money.
Well,
So
no,
first,
but sometimes like a military pension can name the first party special needs trust of said individual to get the
mhm,
monthly distributions. So that's,
mhm,
one way. And then sometimes there's been retirement or pension where the individual with disability may have worked, and now they have a pension where those funds can be redirected to a qualified income trust and still maintain their eligibility. So those are more advanced topics, and we can definitely help with that. But one person also said, what specifically can a distribution from a third party trust be? Isn't it limited? And I would say, I always think of it, if it can be construed as achieving a better life, which is really the able terminology for an individual with a disability, you can pay for it out of a special needs trust for the benefit of said person. I think
mhm,
where people hear, I think there's a lot of, misinformation traveling around where they say that you cannot pay for shelter out of a
mhm,
special needs trust. And that is not true. You absolutely can pay for shelter out of a special needs trust. But if a person is getting SSI, then
mhm,
if you pay for shelter out of a special needs trust, then there would be a one-third reduction to SSI. But if the person
mhm,
is getting childhood disability benefits under a parent's record, also known as DAC benefits, Social Security disability, Social Security retirement, that there is no reduction for those benefits if we pay for housing out of a special needs trust for that.
mhm,
And I just want to mention that we can make those, we can pay for shelter, monthly debt service, and things like that out of an ABLE account without a one-third reduction to SSI. So a special needs trust and an ABLE account work beautifully together.
mhm,
They're not the same, and people are always asking, why do I need both? And it's because an ABLE account has a limited amount of money that you can put in there. It grows tax-free. There's tax-free distributions. And if it can be construed as achieving a better life for an individual with a disability, you can pay for it out of an ABLE account. But again, you can pay for housing or shelter out of an ABLE account without a one-third reduction to SSI. A special needs trust has an unlimited amount of money that could be in it, that you could put in it every year. It could be worth, we had some write-ins where people say they funded their trust with $1 or $10 or $20. And we have some people that have millions of dollars in their trust. So there's an unlimited amount of money in a special needs trust. able accounts grow tax-free and tax-free distributions, and we're here today to talk about the taxation on special needs trusts, which are vastly different than how it works for an able account. So I just wanted to put that out there because there is always a lot of confusion with that. Okay, so let's come back to the inherited IRAs and special needs trust, and let's talk a little bit more about that.
Okay, sounds good. So this is where one of the most important tax planning opportunities, is available. So under the Secure Act, most inherited IRAs must be paid out within 10 years. However, disabled beneficiaries are considered eligible designated beneficiaries. And if it's if it's properly set up to where the beneficiary is the third party special needs trust, you can actually stretch the amount of the IRA over the disabled's lifetime. And so they are not subject to the 10-year limitation, which is huge. This can just, it helps with preserving, decades of pre-tax money to where you can actually plan ahead of time and get the special needs trust in a spot where it's not paying the 37% tax bracket. You can stretch it out over time, and you can use distributions each year as you look through it and plan, as well as funding and able as a tool to keep your taxes lower.
Someone said, is an inherited Roth IRA the best solution to avoid income?
Oh, yes, Roths are great. Roth money is valuable. If you can contribute or you're still required to take the RMDs out. However, it is not taxed. Roth money is not taxed.
And
So
one
you
thing
report.
that some families can do, most of the families that we work with quite often don't have the ability to contribute to a Roth. They make too much money. Even if you make too much money, if your 401k at work offers a Roth option, you can participate in that, and we do recommend that. But there are such things as Roth conversions. So this is a time where your income is lower. Maybe you have retired and you don't have that employment income coming in. Your tax bracket is much lower. And there are such things until they close the door on it, until the IRS closed the door on this. There is a such thing as Roth conversion where you can start converting some of your traditional IRAs or traditional 401ks to Roths, and people like Teresa can help you figure out what the sweet spot is for that. I know we do Roth conversion calculations as well, and I'm really a fan of that, Teresa. I want to say that Roth conversions, when their income is in that lower tax bracket, it's kind of a beautiful thing. When we're looking at a loved one that may have care needs 25 to 35 years after we're gone, it's like another lifetime. So pay it now or pay it later. I think of Roth conversions as a prepaid vacation. Like when we go on vacation,
Yeah.
we pay for it ahead of time. Everything's good. It's so much more enjoyable instead of when you're on vacation, you're thinking, how much does that cost? How much does that cost?
Yeah.
So I think of a Roth IRA as a prepaid vacation, and you're not having to worry about the taxes hanging over you later.
That's right. Yeah, you're absolutely right. There are other ways to do it too. If you do not have an individual IRA account anywhere, you can actually do what's called a backdoor Roth too. It gets a little complicated, but I'm a big fan of that. If you have just 401k money or solo 401k money and not a true IRA sitting anywhere, it's really easy to do your annual IRA, traditional IRA contribution, and then do an automatic conversion to Roth. So Roth is very valuable, and I suggest looking at it annually to see if you have an income year that is lower than normal. It might be a year to take 10,000 or 15,000 off the table and pay the taxes on it. So yeah, we advise clients on that as well.
For able accounts, Teresa, is subject to the gift tax exclusion each year, which the gift tax exclusion is still 19,000. But due to some of the other regulations that have been implemented through Trump, the able account amount for 2026 is actually 20,000. And the additional amount, if they're working, up to their earnings amount is 15,650. So those are the updated numbers for 2026 of what you can put into an ABLE account. One thing I want to mention, Teresa, is when it comes to ABLE accounts, sometimes people think that if their loved one with a disability is working and they
Mhm.
have their income direct deposited to the ABLE account, which some, not all, ABLE accounts allow, that income will not count against them for SSI purposes. And I want to say that that's not true. While they may allow a direct deposit from employment income to the ABLE account, that income is still reportable and
Mhm.
countable for SSI purposes. It's the asset, like if it's over $2,000, that's not counted, but the income would still be counted. That's a question that we get all of the time, so I did want to mention that.
And it's countable for IRS tax return too. Yes.
Some person said, if who's working, the disabled person, and that is exactly who we're talking about. There are many people with disabilities. Clearly, there are people with some with disabilities that will never work. They've never worked, and it is completely impossible for them to work. But there are other people with disabilities that do work. They may work a part-time job or a few hours here and there. And so we are talking about the individual with a disability who is working. Okay.
Yep, that's correct. Okay, I wanted to talk a minute about the ABLE account. As you said, the limit's going up for 2025. It was 19,000. They have to be under, the total balance needs to remain under $100,000 so that you don't have benefits being disrupted for SSI and Medicaid. They are not countable if you're below the $100,000 towards a Medicaid resource, which is lovely. It grows tax deferred, and it's really easy if you can get one in a state that allows you to have a debit card. I have a lot of clients that say that having one that has the debit card is a dream come true because they can use it very easily. We use it in the CPA tax world as a big tool, and that tool it's for the distributions that we talked about earlier on how we can push income away from that highest tax bracket in the trust account to the lower individual 1040 level. So it's used in the CPA world for planning as a tool once the third party special needs trust is funded. Let's talk about some common mistakes here. Um, Lots of tax returns we've amended for the Medicaid waiver difficulty of care payments. W-2s come, 1099s come, they're issued in the parent's name, social security number, and many tax preparers don't realize that the W-2 or the 1099 is truly from a Medicaid waiver program. And that income does need to be reported on your tax return so that the IRS can properly match the income. However, there is a box on the tax forms that you specifically check that says this income is from a Medicaid waiver program difficulty of care payments, which by IRS rule are excluded from being taxed. So that is one of the traps that I see quite a bit and mistakes that are really common with tax returns that we see. And then we, of course, you can amend the last 3 years to get a refund back.
That lends itself
Let's
to one of the questions that had come in today, which was basically like, why do you pay tax on CFC pass hab hours only to claim it back on the tax return? Do you want to talk about that?
Yes, this is, that sounds to me like this is that the individual's asking about the Medicaid difficulty of care payments, how you actually do need to report it on your tax return. That is because the IRS received a W-2 or they received a 1099 with your Social Security number on it. So they're expecting that you report that number. And if you don't, they're going to send you a letter that says, we got this W-2 1099 income, but we don't have a tax return for you. So by reporting it on the tax return, you're reporting it gross. Let's just say you earn $10,000, but then down below, there is a Schedule 1 where you go and you click a box where it will deduct it out at the bottom and explain to them that we're backing it out because it is the difficulty of care payment.
Okay, I want to go to a couple other questions. Someone says, I just opened an ABLE account for my special needs son. As it gets close to $100,000 and we start taking money out, does that need to be reported on the special needs individual tax return? And again, ABLE is tax-free distributions as long as it's being used for the individual with a disability. There's no reporting. The ABLE account is a beautiful thing. And to his point, again, we're mentioning that we don't want it to go over $100,000. So you may need to spend down on that person's behalf from the ABLE account as it is getting close. Some people use it as a savings to spend account. We put money in because we're going to take money out for housing each year or whatever it is. Some people just have it and they don't ever fully fund it. They never put the maximum amount that they could put in each year. They just have it to be able to offload money if the kid was getting close to that $2,000 limit. And I don't think that there is a right or wrong way for that. There's just different schools of thought on that. One person says, can W-2 income from a Medicaid waiver be used as income for a Roth account? So I mean, I guess they're asking if they could use that money to fund a Roth.
Hmm. Um, I would probably need to research those rules. To fund a Roth, you do have to have earned income. So, I would need to look that one up for sure and then get back with you and let you know.
Okay, there was another question from earlier that I want to read. We have not set up a special needs trust yet for our 27-year-old daughter. She has not needed or applied for federal benefits, SSI, Medicaid, Medicare. How do we anticipate her potential use of federal services without having our funds at risk? And so I want to just talk about that because some people may be on here and their kids may have been getting SSI, are getting SSI, and they have been for years. Some people's kids were getting SSI, but then they retired and turned their own Social Security benefits on, and the child moved over to childhood disability benefits. I think that the key is whether or not we believe that the kid is going to qualify, whether you have not applied because the kid has been able to work and is doing fine, or you have not applied because you didn't know you needed to. It doesn't matter. It's not about looking back, it's about looking forward. But when we have a child whose disability started prior to age 22, they have the ability to be covered under a parent's record for Social Security purposes. And so what that means is that if that child has not paid into the system when the parent retires, they have the ability to be covered under a parent's record. So in the example that dad's benefit is $4,000 a month, that child, if their disability started prior to age 22, they'll be eligible for 50% of dad's, which would be $2,000. Now this gets a lot more complicated, and we have a whole webinar on planning government benefits 101. There are such things as family maximums, but I think what I would say is determining whether or not the individual will likely qualify for benefits under their own record, under their parents' record, whether it's SSI or whether it's SSDI or RSDI under a parent's record. That is going to be a big factor. If we don't believe, if the kid is not getting Medicaid, if the kid is not getting SSI or other public benefits, then an ABLE account and a special needs trust might not be necessary, right? And so I would say when you're working with professionals, whoever you work with, kind of going over where you are and how you got to where you are as to the decision to have benefits or not have benefits would probably determine whether or not you need the special needs trust or the ABLE account in the future. Do you want to add to that, Teresa?
No, I completely agree, 100%.
Okay. Can we fund? This comes up all the time. So, and we had somebody in the chat box said family maximum. Family maximum. You can research the family maximum. It's kind of clear as mud on the on the Social Security Administration website, but the family max does matter. So this matters if you got a spouse drawing off benefits, if you've got more than one child with a disability. There's all kinds of factors that can go in. So you do want to research that. So here's the big question, Teresa. Can we fund the ABLE account from a first party special needs trust and use it for my child's best interest, and the court is not in the middle? Currently, court is deciding on all of disbursements.
Hmm. If the court's involved, I'm not quite sure. Typically, though, you can fund it. The ABLE account can be funded by anyone.
Yeah, and one thing I like to mention that, and that is true, an ABLE account can be funded by anyone, but ABLE accounts are a little bit different than like a 529C, even though they're under the tax code 529, it's A versus C. An individual with a disability can really only have one ABLE account, where an individual could be the beneficiary on multiple 529Cs. So that is a little bit different, but actually I could contribute to your daughter's ABLE account if I wanted to. But the interesting thing is when we talk about the gift tax exclusion, we think about per person, they can contribute so much money. And that is not true for the ABLE account. So the maximum for 2026 is 20,000. It's not 20,000 per person that contributes to that ABLE. So those are a few things that this is confusing. If you guys have, listened in and thought about this stuff and you're listening today because you've read a lot and you find it confusing, it is confusing. When we've got the IRS involved, we got the Social Security Administration involved, these legal documents, taxation, all that kind of stuff. It does make it complicated, and that's why it's so critically important that we understand these things and get the right people on the bus to talk through these things and clarify understanding on some of this. So as far as I think it's true in that case, we bypass the court approval. So let's just say the court's not involved in that question at all.
Mhm.
Can we use money from the first party? Can we fund the ABLE account from a first party special needs trust? And I have always heard that that's not an issue. You absolutely could. A first party special needs trust has a Medicaid payback, and an ABLE account has a Medicaid payback depending on the state that you're living in, because we have people that attend all across the United States. We live in Texas, and Texas has a Medicaid payback on ABLE accounts. And Teresa, you probably get this question. I get the question all the time. Is I understand that I can have an ABLE account from any state. Is that correct? And the answer is yes, you
Yes.
absolutely can. And so then the next question is so if I get my ABLE account from a state that does not have a Medicaid payback, do I avoid the Medicaid payback? And the answer is no, because it follows the state in which you live. So if the state in which you live has a Medicaid payback, it really doesn't matter on what state you got your ABLE account in. So I just wanted to put that out there. All right. So are we on to the next slide, or are we on
Yes,
this
we
slide?
can talk about the next slide. Really, it's kind of getting it kind of wrapped up, and it's just that I can't specify enough the cost of getting it wrong. It can be very unfavorable to you. So it takes a lot of planning and it takes a lot of the correct people on the right team. So you need to have someone that understands the benefits on your investment side, such as Allison. You need a good attorney that understands the special needs Medicaid world. And you need a CPA that understands how proactive planning comes into play, especially when the third party trusts are funded. There's also a lot of individual tax returns, deductions that parents can take at the individual tax return level. I've given some talks on that with Allison in the past that talked about deductions at the individual tax return level for your loved one and your dependent as well. I appreciate the time today, and it's a subject near and dear to my heart. And I thank Allison for always having me on.
Well, Teresa, this is a great slide here. The value, the year-end tax planning, the trust income before, project the trust income before December 31st. I think sometimes, we hear about deadlines of April 15th, that's the tax, and we talk about IRA contributions prior to April 15th. And so it's good to understand that it's December 31st for the special needs trust. It is also December 31st for funding the ABLE account for that tax year. So I always like to mention that as well. So when it comes, to getting the right people on the bus, I know we've worked with Teresa in the past, and again, we're fans. We don't do what Teresa does, but we know that the families that we serve need your services. And there is a consolidated planning group referral discount with Teresa's firm. So if you're looking for a new CPA or looking for another set of eyes to help you with the planning, and again, I can't stress getting it right enough. There are a lot of financial firms that are like that, they do what we do and they say that they'll do their taxes, but they don't do it well, right? So I would say we don't do that, by the way. I would say work with the professionals that do it and do it well. When you work with somebody that says they'll do it, but they don't do it well, you end up undoing things. You end up amending returns and fixing things. You may end up owing a lot of money. So I do think that that is important. So I want to talk about, we've got a couple of questions. Before leaving, can we hear what distributions from a third-party trust can be used to offset taxes? I've heard it's limited.
What distributions can be used, you mean?
Yeah,
Or
before
what?
leaving, can we hear what distributions from a third-party trust, I think it means can hold off taxes?
Yeah, so I think what they might be asking is how can we just, what can the special need trust pay for on behalf of the beneficiary possibly? And then that will then distribute income out of the trust at the high tax rate to the individual, is what I'm hearing. And I have a list of some of those things that you can, okay, yes, they're saying yes. Some of the things that you can pay for out of the special needs trust are going to be personal care attendance, vacation, home furnishings, uncovered medical expenses, education, vehicles, physical therapy, recreational, medication, medical equipment, any insurance premiums, job coaching, home renovations to improve accessibility, private counseling, entertainment, recreation tickets, concert tickets, home appliances, clothing, school or camp tuition, telephone service, internet, and funding and able.
She says, but she has heard that that's not able to come from a third party special needs trust. I think my opinion, so I don't know where you've seen that, and if you want to send it to us, you can. But the third party special needs trust and the ABLE account are not restrictive. And again, I think that the language is, again, if it can be construed as achieving a better life for an individual with a disability, you can pay for it out of either one of those accounts. And I've used the example of, let's say that your child is in a wheelchair, and as a result of that, they need an accessible shower. Okay, that would be an allowable expense. It's a home improvement, but it's for the benefit of the individual with a disability. Same thing. Maybe we need to add some concrete to our driveway so we have a bigger apron so the wheelchair can get out of the car appropriately. That would be okay. And then I would say, but don't get crazy. You can't remodel your whole house or your whole kitchen.
Right.
Okay. And that would be an example. So I think as long as it can be construed as achieving a better life, it might be adaptive equipment. It might be a computer. It might be rideshare services. There's so many things that can be paid for out of these accounts. I think it's not as restrictive as you are thinking. So what about local transportation being paid for out of the special needs trust? Uber, Lyft, all of those types of things could be covered. Someone says, will distributions from a special needs trust reported and beneficiary income impact SSDI. And so that's the whole point of the special needs trust. Is that right, Teresa?
That's right. Yeah. So that is one of the most common concerns that we get from clients. And no, the government benefits are not affected by any distributions out of a special needs trust.
One person
So
says, does education include dorm room for post-secondary program? And that could be construed as achieving a better life. So that could be paid for out of an ABLE account. I think I would be careful out of a special needs trust if they are getting SSI, because that could cause a 1/3 reduction to SSI, but it could definitely be paid for out of an ABLE account. So one thing I want to mention, Teresa, some people have a 529C for college for their loved one with a disability, and it was started early, maybe before the disability or before they knew the child may not go to college. And so what I would tell you is don't worry. If that's you and you have a 529C for your loved one with a disability and you don't think they're going to go to college, that 529C, number one, the beneficiary can be changed to your other children that may go to college. If there aren't any other children, you can convert that 529C to an ABLE account. And you have to follow the guidelines each year, so it's 20,000 a year. And the cool thing is the ABLE account could pay for higher education. So maybe it's not now, but maybe 10 years from now, they will go to school. The ABLE account could pay for higher education. But when you leave that in a 529C and they're not going to go to college, if you take the money out of that, then it would be taxed and penalized. So the smart way is to move it over to that ABLE account. It's not a taxable event. And then it will make the money a little bit more nimble on being able to spend it on behalf of your loved one with a disability. Okay, a couple of more questions. We've just got a few minutes left. One said, if there's only $1 in the trust, I don't need to file taxes, do I?
correct.
And this
Remember, I
is
said
true
the
for $10,
$600.
$20. It's just funding the special needs trust. One person says we claimed earned interest on Social Security rather than the TIN trust number. Do we need to correct this?
We created, read it one more time,
We claimed
Allison.
earned interest on the individual, not the individual with the disability. Let's say dad's Social Security rather than the TIN trust number. Do we need to correct this?
Oh, is it a third party or is it a first party
Third
trust?
third party special needs trust.
Oh, yeah, it's supposed to follow the EIN. So
Okay.
depending on the dollar amount, yeah.
Okay, so they may need to make a correction on that.
Mm-hmm.
My special needs trust was prepared 10 years ago. How do I get it reviewed to ensure it's up to date and still relevant? That's a great question. We recommend that your legal documents and special needs trust is reviewed every 3 to 5 years. Doesn't mean it has to be completely replaced, but the laws change. We're happy to make a referral to attorneys that we know are nuanced with special needs. We do suggest that you work with a professional that is nuanced with that. But if it's 10 years old, if it's 15 years old, if it's 20 years old, first of all, I'd just like to say you're not alone, so don't beat yourself up. But it is time to dust it off and get somebody to look at it. We've seen where they haven't been updated. Even the most recent child that is now 15 is not even listed on the document and things like that. So it is important to update that. The trust is set up with $20, but no bank yet. Should we put in a bank, start adding money now or wait? And that's an age-old question is, do we add money now or do we wait? And I think that depends on, is there enough money to fund the trust now and still make sure that you have money and your assets are nimble in the 25 to 35 years that you're going to spend in retirement? I am a fan of keeping your own assets nimble for the 25 to 35 years you're going to spend in retirement. After all, you're paying for this kid's care now, in the past, and and going forward. So keeping your assets available to you during your lifetime is important. Leaving assets upon your death to the special needs trust is what we commonly see. Another thing that we commonly see is life insurance being left to a special needs trust. Life insurance proceeds the beneficiary, the special needs trust. And where this might be a different answer is if grandma and grandpa pass away and they want to fund the special needs trust, then that is fine. We just want to make sure that they leave it directly to the special needs trust for the benefit of said child and not directly to them as a person. Let's see. We've kind of talked about some of the inheritance. I'm not sure. So if you're on today, any advice for professionals that work with all ages and disabilities have yet to be accounted for or accepted by their insurance? I'm not sure I understand. So if you want to clarify that question, or reach out to us directly, I'll certainly help you. And I don't know if you're like saying that maybe they've applied for SSI and Medicaid or have applied for Medicaid and they have not been approved yet. I think a lot of the things when we're talking about having money in the right buckets and preserving eligibility for said benefits, we are, talking about SSI and Medicaid waivers, and that's where the special needs trust and the ABLE accounts come into play. So I don't see anything in the chat box identifying that. We've had a lot of great questions today. Teresa's information is on the screen. It's in the chat box. Everybody today is going to get a link to today's recording and a PDF copy of today's slides. So if you want to go back and review it, if you've got deeper questions and we weren't able to answer them during our time together, reach out, schedule your consultation with Teresa. Mention the CPG webinar for the discounts and the association discounts. Check out our webinars in the future. When you get your slides, there'll be a link to where you can register for future webinars, and we hope to be able to help you as you go forward. We work on a collaborative team here at CPG. We offer free personalized consultations. So if you had questions that didn't get answered today, you have questions about planning for your loved one with a disability, you need to know how much money do I need to fund a special needs trust. This QR code on the screen, if you hover your camera over it, that'll take you to our calendar where you can schedule your free personalized consultation. Well, Teresa, it has certainly been a pleasure here being with you here today. And thank you everyone for your awesome questions and reaching out. And we'll look forward to partnering again with you again soon, Teresa. Thanks so much, everyone, and I hope you have a
Thanks.
great day. Bye now.
Thank you. Bye-bye.